All right, we're live. Thanks so much.
Okay. Can I please get a confirmation that I'm clearly audible?
Yes, all good.
Okay, thank you. In that case, I'll be starting in 3, 2, 1. First of all, a lot of points of framing to put open government out of this debate, and then talking about democratization of the market and why that's inherently a good thing. First of all, it's unclear to what extent open government has a meaningful delta on stopping people from making speculative decisions. Know that there are alternatives which are outside of the scope of this notion. So people can, for example, invest in synthetic derivatives of stocks through very accessible apps, things like Revolut, where in essence you put $50 into a certain stock and a financial institution externally guarantees that if the stock goes up or down, you're going to have a larger amount of money. Insofar as this is still very accessible and people still make gambling decisions on the prices of stocks, whereas they're still uninformed a priori with what opening government fears, it's unclear why people just don't switch to other platforms. They don't have a delta here. Secondly, no, there's a very strong self-regulating mechanism within these no-fee brokerages themselves. We've seen this with GameStop when they stopped the trading of stocks. Know that the company itself has to run a profit. So when volatility becomes too high, when capital adequacy and leverage measures are becoming in favor for the company is likely to stop and break. There's also external regulations, like for example, after the Dodd-Frank imposed by institutions like the SEC and so on and so forth. Note therefore that both internally and externally, we have regulatory response to things that are happening. After the GameStop scandal, or however we want to call it, it's likely we're going to get more regulatory response and more vigilance on the part of these companies. Thirdly, it's unclear why opening government thinks they stop shorting. Know that you don't short as an individual, right? This is what hedge funds usually do, and they have hundreds of thousands, if not millions of dollars pooled into their capital. They are incredibly likely to be able to meet this threshold. If they set it at $2,000, they're still going to be able to short. They're still going to be able to artificially destroy companies like they did with GameStop. The comparative is that on our side of the house, we actually enable collective action in order to stop these things. Insofar as GameStop happened, we say it's a signaling effect to hedge funds who intend to artificially affect stock prices of companies in order to turn a profit, and then as a consequence, affect both people who have value in those assets, therefore directly affecting the amount of money they have, but also the jobs within that company, people depend on that company. We're less likely to see such speculative investments insofar as there's a signaling effect that there's a control mechanism. That's the only comparative. Fourthly, it's unclear why opening government thinks that they gain more information on their side of the house. So literally no mechanism given by Prime Minister as to why people are more informed. What they do, however, is force people to invest more than they've wanted to, right? Because if the minimum threshold is, let's say, $2,000, you have a priori invested more money than you have wanted to in the first place, which means that you stand to lose more if you make a bad decision. If the metric of opening government is to say, look, we want individuals to be shielded from risk, they're less likely to be shielded from risk. The fact that a lot of people invest only a small amount of money, insofar as this is a budget they've set aside, this is a self-regulating mechanism to prevent these financial losses that happen if they bet in a wrong way from incurring certain costs to these individuals. What opening government then changes is that it forces people, if they want to invest in the first place, to take a higher risk and to have less of a buffer if they have made a mistake. Insofar as a lot of individuals are incentivized to do these things and they see it as being easy money. This is advertised, so you go on Facebook, you go on Google, you see all of these ads, you can make easy money. There are YouTube videos of people telling you how they did this. You can access, personal advisors and stuff like this. People are still going to think that they can do it. Problem is they're just going to lose more money. So opening government just destroys the self-regulatory mechanism on their side of the house, and they do not prove a delta. What is on our side the benefit we want to claim? Note that this is incredibly important in terms of democratization of the market, because it allows people to enter with no barriers. Insofar as Robinhood and other such platforms exist, it forces other companies and brokers to remove their fees or to lower their fees. This means that instead of the market being locked in for institutional investors, you now allow small individual investors to access the market as well. The reason why we think it's good is, one, the self-regulatory mechanism that I explained at the beginning, which signals to hedge funds and similar speculative investors that their speculation is no longer safe. And given that large money speculation is what creates market crashes, not literally billions went down the drain in the GameStop crash, that is specifically the place where we want to prevent speculation. But secondly, we just want to claim that this is in general a benefit for people. Note that this allows you to diversify the sources of capital that you have. It allows you to plan with the money you have to have buffers. So if you have value in stocks, you can sell those stocks when you need extra money. This allows you to plan for certain expenses that you might not have done otherwise. This is incredibly important in an age where employment is incredibly volatile. Structural unemployment is on the rise. There was external shocks like economic crises, like pandemics and stuff like this. We see that to flexibilize people's ability to diversify their sources of capital is inherently a good thing. No, this is very often also a quick source of capital, right? Because if you get the bet right, and if you place your money into a stock that's growing and resell it relatively quickly, you can raise capital without having to have the sunk cost of time involved in this analysis, which means that in essence, we just allow more flexibility for small investors. We allow people to earn more capital, and we allow people to spend their money in more different ways, which simply allows them more agency insofar as having capital is a prerequisite for any kind of you fulfilling some definition of your pursuit of happiness. We see this is inherently a good thing. The only response coming from government is to say, but people are going to make bad decisions. Before I take them on the highest ground and explain why, even if that is true, we are completely fine with this, I'm going to take closing government.
So you said that you would have other regulations to prevent GameStop from happening in the future. What would those be if not preventing people from accessing the things that let them mess with GameStop?
So I literally gave you numerous examples. There are external regulations by institutions external to these brokerages. The brokerages themselves stop trading if volatility happens. I also explained why there are self-regulatory mechanisms in terms of the amount of money people invest, lowering the risk of volatility per se. You should have listened to the beginning of my speech. But let's say opening government is right, and people make bad decisions. I'm not sure why I care. There are a number of decisions we allow people to make, and they may have bad consequences, not just for themselves, but for third parties, without limitations. So people can refuse a better job in a better town, which harms themselves and also their family. People with or without an asset threshold can invest money, get it horribly wrong, and go completely bankrupt because they invested in a bad asset. People can choose to take a credit, which you're not going to be able to pay back. The reason why we allow them to do all of these things is because a priori we assume that the maximum amount of information in terms of one, the epistemic access to your desires, wishes, and emotions, but two, the information of your own personal context and how this cross-references to what you are and aren't able to do lies with the person individually. This means that we say there's a principal responsibility and obligation for people to get informed. We allow them to make choices because we believe that a priori they are best placed to find the information necessary for whether a choice is going to be good or bad for them. This, however, also incurs the obligation towards themselves that they get informed. If they do not get informed, we say they're bad. It is not the responsibility of the state to save them from the consequences of their decisions. Without proving this burden, open government cannot win the round for all these reasons alone.
Thank the Leader of Opposition for that speech. To continue case for side government, Deputy Prime Minister. Here.
Hello, testing my microphone. Can I be heard properly?
Yes, you're audible.
All right, sure. Thank you. Hello, everyone. My name is Luigi. My preferred gender pronouns are he, him, they. If you have any POIs, you can raise it in the chat. So I'm going to watch the chat for all of your POIs. Okay, all right, starting my speech in 3, 2, 1, and go. Governments are very strict with different brokers and different financial institutions for good reasons. We force banks, for example, to put high, strict capital requirements so that if they default, the other investors that are part of that also do not take the risk with them. We also implement very strict transparency rules, enforcing them to reveal their financial statements, reveal the credit institutions that they're also affiliated with, so that we can track the paperwork and the process of individuals and the transactions that are always done, that it was done in a meaningful way for the consent of an individual to be taken place. The reason as to why we believe opposition loses this debate is because if they have not proven that these financial non-fee brokerages are actually well-intentioned in being able to allow individuals to do the planning and diversification or great investments that they are able to do with meaningful consent, then they actively do harm to these individuals, and the state does have an obligation to intervene. So I want to have two things in this speech. Number one, why no-fee brokerages have incentives to actively deceive the public and withhold information from these low-asset individuals, and secondly, why we at least believe that why we cannot trust these no-fee brokerages to regulate themselves, which is the core of the rebuttals of the previous speaker. Before this, extraneous rebuttals. Number one, they said we have no delta and there are other platforms they can go to and invest in other stocks in different ways. Number one, we might as well also believe that those are also non-fee brokerages and we would also want to put restrictions on them as well. But the second response to this is very simple. I think that to the extent that you can also prove that there are existing regulations, then your principle is also significantly diluted, because you also believe that there should also be some restrictions, not only on the behalf of the supplier, like the lender in this instance, but also of the depositors, and what restrictions are supposed to be in place for them. And absent these regulations, obviously, as conceded by the previous speaker with the regulations that they are also putting into, that they should put restrictions on their depositors, then they do actively do harm to many individuals, not only to themselves, but also to other investors and other people at the same time. Second, they said that there is planning. Like, it's good to have the ability for them to democratize the information, democratize the financial industry, and make it easier for people to invest. Two reasons as to why this is untrue. Number one, so this isn't actually a flexible source of income. And that's what they market to the public, but it really isn't. And the structured reason David brought to you is that this isn't really an investment. It is a deposit that you are putting in many of these platforms so that they can make decisions for you and go towards another fund, be able to make decisions for investing for you on your behalf, and then say that you are probably going to be better off in the future. Yeah, I know this is the same as what other mutual funds and other banks do, but that's exactly why we believe it was analogous, because other banks are forced to show every single part of the paperwork. They ask for your credentials, they ask for your ability to take a test for your risk appetite, and then give portfolios based on what your risk appetite is most suited for. They also try and make it very clear to you what are the clear repercussions of your investment and why that becomes more harmful. There's a lot of friction involved in this process, but that doesn't exist at all with many of these non-fee brokerages. But the second response I want to make is very simple. If you agree that financial institutions never go away altogether, so when I mean financial institution, I'm talking about other banks and other different hedge funds and other different financial institutions that also exist in the market, if they also go through other investors to invest for you, then there really is no delta at opposition, because if they are also existing with Robinhood and Robinhood also goes to those institutions, then you are supporting our restrictions that there should be preemptive restrictions for all investors with Robinhood, because they're literally skirting a process that they would have otherwise had to go through with many other financial institutions. Lastly, on bad decisions and this argument that they will run on epistemic access and we don't know what a good or bad choice is and the state should only intervene. Number one, we made it very clear from David's speech that this is definitely an intervention policy where we have to intervene for this basis, because if you can prove that these individuals opted into this platform with uninformed consent, then they were basically lied to, and we have an obligation as a state to be able to preemptively intervene. But two, we also prove it to you based on these regulations, there's a special obligation that if one asset falls and you are a low asset holder, you are not only hurting yourself, you are hurting a lot of other investors and other low income asset investors at the same time, which makes and creates these bubbles that David talked about that also spur and become harmful to more and more people. So if bubbles are symmetric to a certain extent, then do not allow these low asset individuals to be part of it. Argument. Why we believe non-fee brokerages have incentives, no thank you, to actively deceive the public and withhold information from low asset investors. Four specific reasons. Number one, they market that you can earn money very quickly. So they can say that these advertisements happen a lot, but these advertisements are much more prominent for many of these platforms precisely because of the friction that is lessened, because of the fact that they hype it in targeted advertisements that for people that are predisposed to seek out for these investments. Number two, they can show and skew the UI of their platforms to make it so easy to be able to get this money. Like in in coins.ph, for example, it's very, very easy for you to invest in Bitcoin, even though it's just like a few buttons that you press, compared to the numerous amount of paperwork that happen with other banks and other brokerages, where you really have to sign more and more forms at the same time, because every single part of the process, you are thinking a little bit more and you are trying to reduce the friction, and you're being able to do so. But now their policy makes it harder for them to be able to think through this process. 3, because they actively do not collect info on your risk appetite, vis-a-vis what my response to you said earlier. But lastly, once you buy in and when you enroll, you also invest in the community that they're a part of. Like, you give your email, your FB credentials, you are co-opted into an echo chamber that people that self-reinforce and ask you to do so. Yeah, go ahead, CO.
It seems that all of the arguments are just against Robinhood as a whole. Why do you allow people with more than $2,000 to invest in Robinhood?
Basically, we're definitely fine for large investors and a lot more people, because to the extent that many of these individuals already have experience in the financial market, as what David brought to you, because they have other assets that they're also earning from at the same time. They have other reasons to believe that they have other financial transactions that you can also show with definitive evidence. Then they are obviously less vulnerable, and platforms can exist to that significant extent. It's the same way we do it at banks, right? We can have a lot of people with high assets to invest in very risky things, and sometimes they're not going to be harmed to the same extent as others, and therefore they also are less exposed to the risk compared to other individuals, and therefore they also expose other individuals to less risk by proxy. Lastly, why we cannot trust individuals to regulate themselves. Number 1, because any response regulation that opt says also concedes and works for our side, because other regulations can also be better. Number 2, because Robinhood and other platforms also seeks to protect itself based on commissions, but not on the actual investments and the investors that they are a part of. That's why they succumb to criticism from the Dems and the Republicans in this instance, because of the fact they restricted trading. Some instances in these policies actually do more harm than good. I don't see why you should trust them to be able to make this decision. Very proud to propose.
Thank the speaker for that speech. To conclude the opening half of this debate, Deputy Leader of Opposition.
Can you hear me?
Yes, all good.
Okay, awesome. Then I will start soon. Look, I do agree with open government. We do regulate financial institutions a lot. That's true. That's why it already works to some extent, and things that needed to be regulated have been regulated. They need to support this specific regulation over all of the other good ones that we support as well in order to win this debate. They cannot just tell you there is big risk with financial institutions and banks, so this equals this specific type of regulation that you need to impose. This is like non sequitur from the characterization that they give and then the conclusion that they make out of this. And we specifically regret this type of regulation. What is important to clarify here? Guys, there's no lending here. Brokerages houses do not lend to people. They just do the transaction. If you want to lend, you go to a bank or you go to other institutions that can offer you this. It's unreasonable and completely not profitable and illegal for them to lend to you as a personal investor in this type of scenario. This is why when they talk about, oh, you will be over leveraged or you are going to have to pay for the debt.
Lovro, I think a lot of speakers can't hear you. Do you mind starting over and be a little louder, if that's okay?
Your audio is soft, I think. Maybe the mic is not close enough to your mouth or something.
Yeah.
Wait, let me just... How about now?
Nah, it's still
No, it's super
soft.
soft.
It's better now. I don't know. Wait, I'm gonna try without the headphones. How about now?
Yeah, perfect.
Okay. If there's echo, then yeah.
No, there's no echo.
Should I start?
You can start from the start. Yeah.
Okay.
From the beginning.
Okay, we'll do that soon. It's always cringy to have to repeat, but I'll do my best. So basically, we do agree with open government that we regulate financial institutions a lot. And this is why it already works, right? They need to prove to you specific reasons
why you need to regulate this policy compared to the overall broad risk that I talk about on the financial sector and banks and all this. And I think the important clarification to make here is that there is no lending here, right? This is a brokerage house. They make the sale that you want them. You either buy a stock or you sell a stock. They're not going to lend you money like a financial institution or an investor or a bank would in order for you to short or to do some sort of other market manipulation. So even if they ban this, even if they put this threshold, people can still with $2,001 go, if someone is going to give them a short ability, that is that they are going to borrow them money, which is highly unlikely if you have no experience. This is why there's also regulations against that. You need to have some sort of credentials in order to be able to engage in the short selling and all of these things. This is literally about people buying stock, selling stock, and it's about the 2,000 threshold, where we should have it or not. So like a large portion of what they talk about is out of this debate. But also, we regulate money in the status quo in what ways? By Dodd-Frank and other regulations, primarily in the United States, but also in Europe after the big recession in 2007, blah, 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 and all these sort of things. So there are collateralization requirements towards clearinghouses in places that removes the ability for this to overblow. This is what happened in the status quo. Literally, there are automatic stop mechanisms for when the market goes crazy and frenzy, and when my grandmother is trying to buy GameStop, that actually forces these low-fee brokerages to not be able to provide these to people anymore. This is the automatic response to the highly unlikely, once in our lifetime event up until now, where the Reddit has been able to do this. And all of the other times where people just normally invested $100, $200, $300, you haven't heard about because there was no problem. So if I tell you that once or in specific occasions where things go bad, there are regulations in place already that stop this, and then for the other 364 days, or for any sort of normal investment where people can invest without the barriers and without the brokerage houses charging them huge premiums, then the balance of harms and benefits is on our side of the house because of what Ian explained in terms of democratization and all this. Let me talk about fiat clarification. They don't have the fiat to ban synthetic derivatives of stock on their side of the house. They have the fiat to ban specifically brokerage houses, Revolut and other financial institutions like banks that offer you the ability to buy a synthetic stock. So you're not owning the stock, but you are owning a virtual stock. So if a stock goes up, your value is also going to go up. If the stock goes down, your value is also going to go down. But you're not owning the stock, you're owning a synthetic derivative of the stock. They don't have the fiat to ban this under this motion. They can say, oh, maybe it's likely if we ban this, we're also going to ban this, but they don't have the fiat. So in the likely scenario that they don't ban this, then what you're doing is artificially redistributing capital and access and profit from brokerage companies who had access to customers before to the other financial institutions who are going to do the same thing without you owning the stock. And this is something which is unfair by the government, because if you have loopholes in your regulation and people can go elsewhere, but also you're forcing or redistributing profits from one type of investor that you say, oh, it's bad, morally hazardous, to just the other type of investments, then you are doing two negatives in this debate, and this is why the government is not principally or morally okay with doing this. But also, and I think this is the most important maybe thing in this debate, the impact here is self-regulatory. Because you are imposing a cap, you are only imposing people who are under the cap. So people who invest very small. This is self-explanatory that this is the only thing that they are doing, meaning that people who would be harmed in the extreme scenarios that they talk about have already invested a low amount of money. And then the comparative harm to that is also low because they have invested a low amount of money. So the negative things that they are preventing need to be compared, especially if they say, oh, these companies have very pernicious incentives, very bad, with the negative effect of companies saying to you, look, I know you wanted to invest $1,000, but let's get you over 2,000 so that you can actually invest in the market, and forcing customers to invest more. So if the problem is that this is inherently bad and leads to people losing money, then people lose more money on their side of the house because you have a threshold and people need to adhere to the threshold, unlike the comparative status quo where some people would be below the threshold. So this is the comparative in this debate, right? But if it's also, money doesn't equal informed consent, right? The ability for you to maybe leverage yourself by your own hands, such as borrow money from your family or from friends, or to take money from bank, is not comparative in this case. I don't understand why a person who would be able to invest $1,000 versus $2,500 is inherently a smarter investor. They have more money, but it doesn't say anything about their understanding of the market or the understanding of the risks. If you want to regulate these things, how about you mandate that people need to be informed about a couple of things before investing? How about you require brokerage companies to tell people about the risk, like they already are doing to some extent, or like you can already do with, I don't know, like the the risks when you go to have a credit from the bank and all of these things. These are the things that lead to financial transparency and information to the people, not an arbitrary limit for how much they can enter or not enter the market. But also, I want to talk about the idea of why the accusation of political influence on their side of the house. So, Janet Yellen and all of these big folks have actually, rallied up against the GameStop boys, and this is like destroying the market. It's going to lead to a lot more irrational regulation or a lot more bad PR on institutional investors and hedge fund investors. And this is going to be a bad thing because it's going to split the market, and it's also going to make people fall for populistic reasons, right? So, for example, when AOC said, the reason why Robinhood actually stopped trading is because Janet Yellen told them, unlike that, Robinhood was actually losing money in this sort of case. This is bad for high-end financial politics. I don't care if this is not accessible to people. It is bad that you have these pressures. CG.
Right. If you can invest elsewhere, doesn't that mean you can diversify your portfolio regardless?
Yes, then you lose impact, and you redistribute gains. So I mean, you can diversify your portfolio less or more on both sides of the house. You don't necessarily need to do this more comparative on your side of the house. I don't understand. Maybe I can respond in the POI if you run this argument. Okay, so we explain why democratization of the market is good, why people who invest little amounts of money are also people and should be able to invest if they want to, if they make financial decisions. If you are happy with people gambling or giving their money to the bank or investing in some sort of other things, financial instruments, then you should be happy with this inherently, unless they prove to us that this is more dangerous. And I prove to you that this is more regulated, so it's probably less dangerous. But also, when inherently, if they want to talk about diluting of shares, which is probably there's some place here for CG extension. It's likely that people will defer their management rights to bigger managing groups. It's likely that we have regulation against the company being disabled by small stockholders already in place, and the democratization of the process of running a company is actually a good thing. So in our side of the house, we do prefer 1,000 people having maybe one share in a company. That's a good thing in the end. Very proud to oppose.
Thank the speaker for that speech. To open the closing half of this debate, member of government, you're here.
Hello, is my audio working? Just making sure.
Yes, all good.
Okay, cool. Let me just set up my timer. Two constructive contributions. The first thing we'll do is to tweak the principle in a way that it is able to differentiate between people who are below the threshold and people who are above the threshold. Because the principle of risk, or the principle of the obligation to pay, or the principle of imperfect information is an argument against people in general investing in these things, and we think that's pointed out by CO in the POI and OO in their speeches. We will argue that one, you have asymmetric information that you're entering this stock trade at a systemic disadvantage, and so far as you are under that threshold, and we will prove reasons why money is likely a good indicator of that information. Two, we think there is a massive risk of third-party harm when people who are under that information are likely to be victimized by the people who know more. And then thirdly, we're just going to adjust as well the market analysis. And we're not going to talk about the general unimpacted concept of market stability. We will say that the stability benefits one, institutional investors that provide a lot of public services to precisely these people who are under this threshold, and two, businesses who probably have a right to compete in a normal market where the stocks do not go crazy just because people, wanted to troll on Reddit. Before I go on to those ideas, a few extraneous rebuttals. The first is they say that people can borrow money and they will just get around it. The first rebuttal to this is that realistically, a bank will not give you a loan for this, right? You need to explain to a bank why you are borrowing this money. And if your explanation is that I want to invest in Robinhood, you will likely not only get denied, but probably get laughed out the building. So that idea of getting around the system probably doesn't work. Two, those people are going to have to repay those $2,000 eventually as well. So not wanting to, have their assets seized because they will default on that loan, people will probably choose to not take that incredibly risky $2,000 loan either. So I think that kills OO's rebuttals against the model from OG. Secondly, they said that regulation is sufficient because it exists. And I think it's opposition's burden to tell you why this regulation will work. And I feel like the DLO idea of mandating it based on other things is also kind of underbuilt and also kind of undermines LO's principles. So I don't think that part can be credited. But if their argument is the existence of Dodd-Frank or other laws in the US, I just want to point out, like, I live in the Philippines, and if I wanted to, I could download on my phone right now this app, like maybe use a VPN, and literally start trading, right? And start fucking investing in these stocks as Amo was speaking if I wanted to. But precisely because these regulations don't exist internationally. And therefore, given that it does not exist everywhere, the states that do have the ability to control what these apps do and should not do should also protect the rest of the people who do not have those regulations within their own countries from being able to be harmed by this app. So I think that's also a new rebuttal that works better against OO because it shows that regulation is not a universal concept. If it's an app that literally exists everywhere. Firstly, let's tweak the principle coming from opening government, because we think a fair point is raised that it does not explain why the problems faced by people under the $2,000 threshold are not faced by people above this threshold. The first thing I would say is that that kind of asset value is probably going to be used as a proxy for things like your wealth. That's to say, the people who are able to afford that, for unfortunate capitalistic reasons and status quo, are likelier to be able to afford a college education, are likelier to be able to afford regular and consistent internet access, are likelier to be able to afford investment gurus who can teach them this kind of shit. So we do think that those people who are above that threshold have shown a basic competency in terms of being able to invest in these things, precisely because even if they don't do it themselves, they probably have ample resources to do these things and probably an incentive to do these things insofar as they don't want to lose their money. The other thing this shows is that it shows that the information people are acting on in terms of when they're investing is asymmetrical, that one group of people is just massively going to be able to profit from these stocks even more. And that's where the third-party harm comes in. There's the people who are richer that always get to pull out their investment first. The people who can use quick math to predict when the stock price will stop rising and go down. The people who have constant internet access and therefore they will be the first ones to be able to pull out. Those kinds of things mean that this is precisely the people who are able to compete at a much higher playing field. Fun fact about GameStop, if you go down the Reddit comments, eventually you get people who are complaining about how they were not able to pull out their stock in time because the internet crashed. They were not able to pull out their stock in time because they did not fully understand, or they did not were not able to fully educate themselves through things like proprietary courses on finance about the implications of what they were investing in. And it is precisely those people that we are trying to protect. And even in the worst case, where a rich person loses out their money, we would say the fact that they are able to meet that threshold means that they probably had the opportunity to provide that from other people. I will take OO since they seem to want to say something. Yes.
So this is not big enough ever to disturb the market as a whole. It can disturb some really small companies like GameStop, but it's never going to disturb like top 500 Fortune companies. And that's why your case does not have an impact in that regard with stability of companies.
No, it has an impact on the people who literally lost their life savings on this. I think that's enough, given that those are the people we're regulating. And again, like if the response to that is you consented anyway, I would say that most people regret giving that consent, and the state, they probably wish the state had held back their hand before they invested in those kinds of things. But to directly engage with that, I want to talk about the idea of who this directly affects. The first thing I would say is that this is likely to affect GameStop, precisely because it is the influx of low-income investors and the investors who are just doing it for the memes or doing it for the trolling that allowed extra market forces to affect things like the natural competition between different gaming stores. That's to say, even though GameStop had been performing badly, had not been providing adequate services to its consumers, and therefore its stock price was falling, because a bunch of Redditors felt like fucking trolls and were easily able to get into the market, they were able to distort the stock price and provide them an unfair competitive advantage against other stores. Secondly, literally the institutional investors went bankrupt because randos kept flooding the app. I think in terms of preventing those people from being hurt by risk investments, they are probably going to have more money and therefore more stability to offer things like loans to indigent people, offer things like risky loans to people who they probably would have been too risk averse to provide to in the first place. And therefore, even those indigent people are benefited by the success of institutional investors insofar as they feel comfortable enough to offer loans and offer other kinds of credit to those people where they don't think their investment is constantly going to die. 1, we fixed the principle. 2, we destroyed the rebuttals to the model. 3, we showed you that this harms very specific actors in incredibly unfair ways. City.
Thank the speaker for that speech. To extend case for side opposition, member of OP here.
Can you hear me?
Yes, loud and clear.
Great. If my internet gets stuck for some reason, please write in the chat and I close my camera, but it's supposed to be okay. So 3, 2, 1, go. First of all, Hadar, I'm very sorry because this motion is ruined. The mechanism is really stupid. $2,000 is nothing. Most of the assets minimums in all over the world are between 20K to 50K to 100K dollars. In Israel, it's about 70K dollars. We think that therefore this motion loses most of the impact that should have been in these motions. All of the far-reaching impacts on all of the markets and the bubbles and the risky things are just irrelevant because this is such small amount of money that almost never happens. Therefore, the most important groups that actually is affected by this motion are the people that do have less than $2,000. And therefore, those people, by the way, I apologize to Adar because she's in the 18. But those people are being affected by this motion. And therefore, the main clash within this debate is whether those people are going to gain from being able to have access to those platform or going to lose from that. If we show that they are going to gain, we will in the way rebut all of the principles which are really practical, like asymmetry involved information cases from the other side, and we'll show that it's create good things within the lives of those people. I'm going to do two things in my speech. First of all, explain to you why there aren't far-reaching impacts of this motion, and secondly, tell you how it affects the life of those people. Before that, just one point of external rebuttal, the rest will be in the motion, just about like the lousy internet stuff. I really don't know why it is connected. In most countries that are not the US, you can't trade through the US systems. In Israel, it is definitely banned. We are fine with these things being banned, or the US banning other people from other nations to invest through Robinhood. But within the US, which like 95% of the people who invest in Robinhood come from, most people have enough of internet to look at the text and click a button, especially the people who care enough about the financial market to download this app to their smartphone. So we think that this case is just completely irrelevant. Therefore, all of the things about being extremely slow because of internet, I don't know, not relevant. Let's go on. So why does this motion doesn't have any far-reaching impact? First of all, because this is literally a very small amount of money. Like most of the capital in the world is being held by the biggest 5% of the earners, like more than 80% of the capital is within those people. And we think that there are literally hundreds, probably hundreds of trillions of dollars within the market. Like Apple alone is worth more than 2 trillion. There are like thousands of companies. There are many trillions of dollars within this market. Secondly, we think that the traders that actually use this money are also trading in much bigger volume than the traders in Robinhood, who might go into their app once a day, twice a day, but that means that a very big aspect of the volume that happens in trading is happening because of the other people who control most of the money, which means that the way that prices of shares are affected is because of those people and not because of Robinhood specifically. Third of all, even within Robinhood, most of the people have more than $3,000. How do I know that? Because think about it. Even if there would have been 500 million people with less than $2,000, we'd have less than $1 trillion in Robinhood, which doesn't have this much amount of money, but it's still about 1% of the entire money in the capital, which means that this doesn't have vast effects and bubbles and all of those things. In the vast majority of cases, all of those far-reaching things doesn't happen. What is the impact of that? That means that all of those things about those things affecting the things are not relevant. Even within GameStop specifically, billionaires and people in Robinhood with more than $2,000 are most of the things that cause this, not the people with $10 that bought one stock of GameStop. But secondly, it means that also making the market better, like the brokers better through Robinhood and like the fees getting smaller and stuff is also relevant because they compete for the people that has more than $2,000 because they also have minimum assets things, which means that Robinhood competes versus them in both sides of the house, which makes this case of OO, although interesting, not relevant to this specific motion. Secondly, let's talk about how the people are going to get good things from this motion. Before that, I'll take OG. Yes.
So I think the important thing that nobody's responded to yet is that the existence of a minimum increases liquidity for the market itself, which is why it keeps the platform upright in the first place.
Great. So if you talk about the liquidity of the platform specifically, the fact that there are many people within money within the platform give the platform liquidity, and also the fact that there are enough people with more than $2,000 probably gives enough liquidity. If the platform is bad because of less liquidity, that means that it will probably disallow it yourself and doesn't need the government to do that. Okay, so let's go on to why the people succeed. So first of all, OG tells us that the company's interest, and CG repeats them, have an interest to hide information and like don't give people enough information, and all of the people are stupid. We definitely don't think that this is true. Why is that? The company doesn't earn money when you lose money. It's just a platform that you trade through and gains money when you trade more. Therefore, the interest of the company is to make you to trade more. And in the long term, that means that the interest is for you not to lose all of your money, because then you probably stop trading and tell your friends that this platform sucks. Therefore, they don't come to use this platform as well. Therefore, they don't want you to lose all your money. They want you to be reasonable. Secondly, OG tells us, but people can lose a lot of money through shorts, and this is infinite losses. First of all, that might be a reason to ban shorts. That's not a reason to ban everything else within the platform. Secondly, there are cut losses mechanisms that still stop you from losing the money in shorts specifically. We can implement them. This is not the motion that OG talks about, and certainly doesn't relate it to minimum assets. But thirdly, the most important argument within the opening half was whether people are informed enough. And O kind of lets go of this argument and says, I have a right even if I'm not informed, which might be true generally, but it doesn't mean you should have access to specific things. Like you don't have access. We do ban cults and ban you the access for cults. We do ban you from buying medicine that have prescriptions, because you might have rights to some things, but if you're stupid enough, we ban this right from you. Therefore, we are the ones that are actually going to analyze you why people do have enough information for that. So first of all, on that, we already told you that the companies do have interest to give them information. But secondly, we say that people very easily can access a lot of information within their platform. Why is that? Because people can see the cases of many people, like the investments of many people, and see which one got money, which one lost money, which sort of investment get money. And in many of the platforms, you can click like follow and buy with 10% of your money or 50% of your money the exact same case that people have that have succeeded while investing, which means that you follow the people who knows best in many cases. You even diversify by 10% of that, 10% of that, and 10% of that, because this is how you think you'll get the most money. Secondly, because we think that people generally likes to follow like the S&P and stuff like that, because they think it's going to be good. And we think that generally the S&P rises all through the years, and most people will make those decisions. Thirdly, people talk to each other. So when someone loses a lot of money because you put things on silver, you know that commodities might be risky and you won't do it in the future. Therefore, we think that most people are just going to get money from that. The alternative is that people don't have the ability to put their money in the markets, which means poor people are going to not invest their money, not get percentage of revenue every year because of letting your money. Less people to poor people is bad things. We help poor people to get more good money, which is a good thing, and the biggest clearer impact that actually happens in the lousy mechanism of OG. Please oppose.
Thank the speaker for that speech. To conclude case for side government whip, here.
Hi, I hope I'm audible.
Yes, all good.
Right. So in the previous debate, my Wi-Fi was kind of weird. So again, similar to MO, let me know in the chat, or try to ask my partner to call me if ever the problem exists. Starting my speech in 3, 2, 1. I don't have anyone to apologize to, because I do think MG wins the debate single-handedly. Firstly, on whether individuals should be able to do this insofar as we fix the principle and therefore respond to OO. But also secondly, preempting the majority of the CO case about at least poor people can make money. I think it's quite obvious poor people can probably make money in other ways, like, I don't know, getting jobs, as opposed to having to wait on to invest to GameStop. I think that is quite a ridiculous claim. First thing I'll do before I go on to the issues is just to deal with the model bashing, because that is the main standard that CO enters the debate. I think if it were about 50K or 100K, it's not going to change the argument on either side. Risk will still stand on OG. The ideas of regulation already existing will still stand from OO. The case about how this is an inept harm to an individual as opposed to just Robinhood being bad still stands from CG. At the point at which their only response was that the model is wrong and insignificant, there is no change from CO's case. I also think that if it is true that it is an insignificant amount of money, it does not take down the principle about how the poorest individuals with less than 2K probably cannot opt into it and at least ruin their lives on our side. Therefore, that still stands. I think as well, like, I mean, OG implies this, but probably getting a finance master's is a better time spent than debating this in BP. If we had to discuss this for an hour, I don't think that really is the point of the debate. The number itself doesn't matter because you can literally shift it around. Two issues, therefore. Should individuals be able to do this, interact with the opening debate? Secondly, on how about the general idea of market failures and how you weigh out against OG. Before I move on, if there's a POI, I'd love to because I have a lot of things to deal with.
Yeah.
No, I'll just move on. Okay, cool.
Yeah, so the comparative with information is even the biggest institutional investors do not beat the market, except maybe Buffett. So the comparative in information is no one is informed in the market.
No, I mean, I think the majority of the time when at least these are individuals who not only just have better access to internet, I think that's a weird straw man from CO, people who have access to financial literacy mechanisms, people who are able to better understand and not be as desperate as they are poor because they cannot put food on the table, at least they're far more likely to be rational and are actually more likely to co-opt the idea of self-regulation because on their side, there are poor people who are likely to be more desperate. Therefore, that information is intrinsically less valuable, even if the information exists because individuals are not able to access it. So I think that directly responds to the point. First issue, should individuals be able to do this? The problem with opening is that it was a deadlock of principles. OO kind of wins this by saying that individuals should make their own decisions. OG pushes back by saying, no, they will deceive the public. I will point out that the problem with the OG principle is it does not cover what happens for individuals with less assets. They just say that Robinhood has incentives to be terrible. The LO wins opening by explaining how money is arbitrary and this is enough. How we break it, coming from MG, is by explaining that the standard of state intervention isn't just market failure. Because we do agree that probably this doesn't affect the largest companies, but it does affect the lives of individuals and the inability of investors to readjust their preparation for no-fee brokerages, particularly because the characterization of these individuals, regardless if it's 2K, regardless if it's 50K, are probably individuals who are likely to be more desperate, likely turning to the stock market because they are turned away from banks, probably means that they are unable to be as rational and are unable to use the mechanism of self-regulation that OO asserts. On a comparative, this metric is important because it fixes the nuanced response to off-bench, that we are ambivalent about Robinhood being good or not. This is a question of individuals themselves. Insofar as the state is supposed to have a social contract with individuals, we think it is correct for them to intervene for this metric. Their only direct response from CO was to straw man and say, Laos, the internet doesn't happen. That's not the point. The point is that poor individuals have structural barriers, not only to accessing physical things because they probably live in barangays or rather cities or areas in which there are lesser investment in how you have more technology, but they also probably are less able to worry about financial literacy insofar as they have a mid-level job that they are like middle management for. They do not have ample time to research so much about it. They do not have the luxury of being able to worry about whether or not they can invest it in a particular stock or not. That likely means that they're less able to be as rational as CO wants. They have not responded to this. Therefore, we do think that the regulations are good insofar as state intervention matters. The second half of the principle was supposedly poor people should get money. And this is the CO extension that is rehashed from LO. I think this is a little confusing because teams had different claims. I will flag that the main response is there are other ways for poor people to get money. Like, there are jobs that's probably more accessible than having to learn how the stock market is volatile and how it changes. But secondly, assuming but not conceding to LO's argument, there are other brokerages, which is their main response, then there are probably other ways in which people can diversify their portfolio. And this was a POI. Because if that is what DLO says, that, again, diversification happened on their side, that trades off the LO argument about diversification is an exclusive value for you to have sources of capital. Assuming OO's mitigation of well, there are other regulations. Again, regulation existing is often adhered to probably on a very base level. I think it's good for you to have more regulations. But secondly, and this is, I guess, the more correct characterization under this, if they say that, well, this is important because other banks, as I saw that they hear my partner when my partner explained that banks will not let them borrow for other reasons. I think this is the reason why people will go into Robinhood and no-fee brokerages with more desperation, particularly because other regulations work. And therefore, on their side, individuals, you can respond to me in a sec, individuals will be able to opt into stock or will be opt into these no-fee brokerages feeling like they are so desperate because banks don't give them money, other standards don't give them money. Therefore, it's harder for them to be incredibly rational and self-regulate. This is where the tipping point matters. It's about financial literacy and investment. It's about you, if you are someone who is richer, regardless of 2K, regardless of 50K, are able to cushion that with less desperation. Therefore, we can co-opt the idea of self-regulation. The point is people can self-regulate better when there are individuals who do not need to be desperate or working mid-level jobs. That is the justification for the policy. But secondly, diversifying your portfolio takes a backseat if how you make money is incredibly volatile. That means that you can easily lose out money for the large rewards that you get from CO. I do not think that is justifiable because the only metric is people can get a large amount of money. I do not think that is a standard here insofar as there is still a harm that exists to a lot of these individuals. You fuck up their lives and ruin their lives insofar as there are very little mechanisms for the specific arena of financial industries. Therefore, I do think that we're okay with trading that off. Lastly, on the metric of individual capacity, then market failure. So I think we've already won the idea of individual harm and why this is important for state intervention. For all the extensions we got from MG, I don't think it was directly responded to. The way out against opening government is because you were better able to respond to the push from up about what this means for individuals independent of what this means for market failure. We think that is an outcome independent value that you must credit, particularly because self-regulation is easily co-optable. This debate is about the tipping point. We win the tipping point. For all these reasons.
Thank the speaker for that speech. To conclude side opposition's case and this debate, opposition whip here.
Am I audible?
Yes, all good.
Great.
Before we start, do you want to be streamed or not?
Yeah, sure, you can stream. Thank you for checking. I am going to start in 3, 2, 1. Look, panel, it's really important to be, sharp on the rules of debate. We are not model bashing. We are talking about the specific debate as it happened in this room. In this room, when OG were specifically asked what the threshold is that we are setting, they said $2,000. We think that this is sad because $2,000 literally makes it so that there is almost no impact in this debate at all. We are the ones who showed you that, and therefore we are the only ones who managed to recognize and notice what is the difference in this debate, what is the group that is actually affected giving this mechanism, and we are the ones who analyzed why it's super important to them to be able to invest through this specific mechanism. We think that there are two main questions in this debate. A, the principled question, and B, where people are better off. Let's be exact on where it is that our extension plays into both of these things, because Ido explained to you two things. A, what the company's incentives are in Robinhood and why those incentives line up with the interests of the users, in that the company doesn't make money when people lose money, right? It doesn't want you to lose money. It wants you to continue to invest. Because of that, it wants you to continue to have money to invest. In addition, it is competitive with other platforms that are doing the exact same thing. For that reason, it has an incentive to make it easier for you to do that through them and to give you access to the information you need and to give you access in a better way than all of these other platforms. What does this mean at the end of the day? Look, what OG tell us about the principle is twofold. They tell us first that people cannot make an informed decision because they don't have access to information and they are being lied to. First of all, we just think that the assumption that people want you to go on their platform to make money and then you have incentives to make them lose money is just weird in the first place, and we just don't think it's true or any of that happens. We think that is a very weird assertion. But moreover, notice that on the principle of giving access to more information, Ido is the one who analyzed why through these platforms they actually have access to more information and they are actually able to get this information by saying that you have access to seeing how other people who are better at investing are investing. You actually have access to explanation of what the different indexes mean and what they are so that you can make informed decisions. He explained why by using these applications gives you access to this information and therefore allows you to more freely make decisions about what you want to try to make money this way or in other ways. That said, on OG's own principle of where you have actual access to more information, we think that we get that on our side and therefore people can actually use this. But then they tell us that I don't know, they say that you can hurt others if you lose money on this platform. First of all, notice, I don't know, if I lose $500, I don't think that's going to have a very big impact on whether or not other people are losing money on this platform. This doesn't count the big instability. This doesn't lead to the big instability outcomes that they talk about in any way. We're talking about very small sums of money, and therefore all of their big outcomes don't actually happen. But B, notice that these incentives and the reason you are able to actually make money off of them, even if it's in really small amounts, means that most people are just likely to make money off of this. And therefore, we're not actually going to hurt other people. The other outcome is more likely. Why do we think that this principle and this analysis makes it easier, is better placed to win this clash than OO? Look, what OO say on this is basically the classic, people can make the best decisions about themselves if they have all of the information and they can take it upon themselves to get all of this information, then they are best placed to make decisions about themselves. First of all, this is literally an argument against regulating anything, just as Ido said, right? Because people can always just have access to information. But then CG do say that there is an asymmetry of information and people who have an active incentive to hide this information from you to keep in power. This is why when Ido analyzes to you why it is specifically these platforms that have an incentive to give you information, because they want you to keep using them and to continue to show you all the different indexes and things we already talked about. We showed you why in this specific case, these platforms fix an imbalance of information that actually allow you to make this informed decision about yourself in the best possible way. This is why we are a better place to just explain why when people use these platforms, they have this information, they have access to it, and it's super important. This is why we think that we win on this principled question. But then the other question in this debate is that people are just better off. Okay, so let's talk about this. Opening governments say a lot of people can lose a lot of money. So first of all, as Ido pointed out, you can only lose as much money as you invest, other than if you're investing in shorts. As far as I understand, A, there's a loss cutting off thing that you can do in shorts. So we're really, really fine with not letting people lose too much money. And B, we're particularly fine with regulating who is allowed to short stocks and who isn't allowed to short stocks. And that's fine. So we just don't think that people can actually lose that large amount of money. But also the reasons they give for why people are likely to use money are exactly those weird company incentives that they gave us, right? It all depends on that analysis on why, if company incentives is to hide information from you and you aren't actually able to make good decisions and all of these things, then you are likely to lose money. When Ido shows you why you can copy people who are making good investments and you're actually given the information and the company incentives are to help you make money, then we show you why people aren't actually that likely to lose the money, and therefore this is a good thing. What do OO tell us about where people are better off? Look, they have this big case about democratization, and it ends the main piece of analysis there is that brokers are going to want to compete for these small amounts of money, and therefore tomorrow they are more democratized. We think that this is just false. Before I explain why, I will take CG.
How will you explain the concept of a margin call to a homeless person with no background in finance?
Okay, I think that I would explain it. I don't know, maybe if I was on the board of one of these companies and I had an active incentive to get these people to understand so they don't lose money on my platform, so they can continue trading on my platform, I would develop a very good explanatory video that would show them how to use this properly. Look, my company incentives are to get them to make money, and therefore I will find the best way to make this accessible to them. Look, we just think that brokers want the large scale money, therefore that they are competing at best for the people who already have $2,000 to invest, and therefore this happens on Gov side of the motion and will happen after the motion too, and we just don't think these big impacts happen. But then they say taking out loans is bad because you can't pay back, and we just think that we are talking about the more likely scenario in which people aren't taking out loans because people who don't have $2,000 to invest often don't have access to loans because banks won't give it to them. Therefore, the main question that we bring into this debate is why it's important to let these people trade their money using this, because we think that it is far more likely that they actually manage to make money, learn how to invest, are better placed to continue to make investments and grow their money and manage to, I don't know, grow their business or do that in ways that aren't taking out loans and aren't actually harmful to them. And for those reasons, please oppose.
Thank all speakers for that debate. If you're not a judge, that is, if you're not Amrit, Daniel, or I, please leave this room, and the results will be announced via Discord or as Ofcom chooses to. Thank you very much.
Thanks all for the round.
Thank you.
Thank you.
Thank you. Salamat.